The market is currently closed, and Opendoor Technologies, Open, last traded at a closing price of $6.65 on Friday, September 5, 2025. This figure stands in stark contrast to the dominant narrative that has propelled this stock into a stratospheric rally. The expectation has been a linear, uninterrupted ascent driven by a short squeeze and a belief in a housing market rebound. But the reality is far more complex, and in some ways, far more precarious. While the stock has seen a breathtaking surge, gaining over 900% in the last 3 months alone, this rally is built on a foundation of conflicting signals, and most importantly, on a recent financial forecast that many investors are simply choosing to ignore. The tension here is palpable. The price action suggests unbridled optimism, while the company's own forward-looking statements paint a picture of continued struggle. This is not the clean recovery story many are buying into. It is a high-stakes bet on whether the company can execute a radical business model transformation in the face of significant macroeconomic headwinds. The recent price movement has been nothing short of spectacular. On Friday alone, the stock saw a significant jump, building on the momentum of a week that saw it hit a new 52-week high of $6.85. This isn't a slow, deliberate climb. It's a vertical launch, fueled by high trading volumes and a massive wave of retail investor interest. This dynamic is a classic sign of a short squeeze, where a large number of investors betting against the stock are forced to buy back shares as the price rises, further accelerating the upward trajectory. With a significant portion of the public float held by short sellers, the potential for this kind of event has been a key theme for months. We've seen this same kind of retail-driven frenzy in names like Tesla stock and Robinhood, where individual investors, often coordinating through online forums, can exert immense pressure on heavily shorted names. But what's fascinating is that this rally has been in defiance of traditional Wall Street analysis. While retail investors have poured millions into the stock, major institutional players, including Fidelity and Vanguard, have been reducing their stakes in recent months. This divergence between the emotional, momentum-driven buying of individual brokerage accounts and the more calculated, risk-averse selling of institutional funds is the central tension in the Opendoor story right now. It's a testament to the power of invest online culture and the rise of self-investing, where platforms like Schwab Intelligent Portfolios and SoFi Invest have put the tools of the market directly in the hands of the public, sometimes with unpredictable results. The question isn't just about what Opendoor is doing, it's about who is trading it and why. This rally is particularly perplexing given the company's recent Q2 2025 earnings report. On the surface, the report was a beat. Opendoor announced revenue of $1.57 billion, which was above analyst expectations, and most notably, it achieved its first positive adjusted EBITDA since 2022. This news was initially met with excitement. However, the true reality lies in their guidance for Q3. Management projected a significant sequential drop in revenue, guiding for a range of $800 million to $875 million, a figure that fell far short of market consensus. They also forecast a return to an adjusted EBITDA loss. This forward-looking guidance is the reality check that a soaring stock price seems to be ignoring. It suggests that the underlying business is still navigating a very difficult housing market, marked by high interest rates and a slowdown in transactions. While the second quarter showed a glimmer of hope, the third quarter outlook suggests that the path to consistent profitability is not as straightforward as the bulls believe. This is a crucial detail that a quick glance at a Fidelity trading platform or a Robinhood app might miss. It's the difference between a superficial news headline and a deep dive into the financial statements. The company's own numbers are signaling a deceleration, yet the market is accelerating. This is the expectation versus reality dynamic in its purest form. Opendoor's core business model, known as iBuying, involves using technology to make instant cash offers on homes, then reselling them after making necessary repairs. It's a capital-intensive model that thrives in a stable, liquid housing market. The goal is to turn over homes quickly, generating revenue and a small profit margin on each transaction. It's a similar principle to a dealer making a quick flip on a car. However, when the housing market cools, this model becomes a liability. Inventory can sit for longer, carrying costs pile up, and the company can be forced to sell homes at a loss. This is precisely what happened in previous quarters and what the recent guidance implies could happen again. The company is attempting to pivot, expanding into new, more capital-light business lines like brokerage services and other real estate products. This strategic shift is a direct response to the inherent volatility of their iBuying model. It is an effort to build a more resilient business, less susceptible to the swings of the housing cycle. The success of this pivot, however, is a long-term play, and the market's current valuation seems to be pricing in a swift, flawless transition that is far from guaranteed. The broader macroeconomic environment is the other key factor. The expectation for Opendoor's rebound is directly tied to a belief that the Federal Reserve will begin cutting interest rates, which would inject liquidity and new life into the housing market. But the timing and pace of those cuts are far from certain. Inflation remains a concern, and the Fed has consistently maintained a data-dependent stance. This uncertainty is a massive risk for Opendoor. If rates stay higher for longer, the company will continue to face a challenging environment, making it harder to sell homes and eroding its profit margins. This is where the narrative clashes with the macroeconomic reality. The market's bullishness on Opendoor is essentially a proxy bet on the Fed's next move. It's a macro play disguised as a micro one. This is a common theme with stocks sensitive to economic conditions, much like the broader tech sector with companies like Nvidia stock or even the consumer goods industry. The interconnectedness of these factors means that a simple investment thesis can unravel quickly if the underlying economic assumptions prove false. The technical chart of Opendoor is a testament to this wild ride. The stock has broken through several key resistance levels, with its RSI, Relative Strength Index, indicator showing it to be in an overbought territory. This suggests that the stock's price rise has been too fast, too soon, and may be due for a pullback. However, in a strong momentum-driven market, technical indicators can remain overbought for extended periods. It's the kind of volatility that would make a traditional investment help advisor on a Fidelity Investments platform wary, but which is a playground for high-risk, high-reward traders on platforms like Interactive Brokers. The trading volume has been massive, with over 125 million shares trading hands on Friday alone, far exceeding its average volume. This is not just a handful of day traders, it's a frenzy of activity. This kind of volume indicates extreme interest and a tug-of-war between buyers and sellers, though right now, the buyers are clearly winning. The key question for anyone considering an investment is whether this is a sustainable rally driven by a fundamental shift in the company's prospects or a short-term phenomenon fueled by speculation and the forced buying of short sellers. The contrast between institutional and retail sentiment is particularly noteworthy. While the individual brokerage investor, perhaps using a SoFi Invest robo-advisor or a simple Fidelity mobile app, sees a massive potential for a rebound and a short squeeze, large-scale investors are more cautious. Fintel data shows that some of the largest institutional investors have been paring back their holdings. This could be a signal of profit-taking, but it could also indicate a lack of conviction in the company's ability to navigate the coming quarters. They may be looking at the company's own guidance and choosing to prioritize capital preservation over chasing a speculative rally. This kind of institutional selling could put a damper on the momentum if it were to accelerate. The savvy investor must ask themselves, if the big money is getting out, why am I getting in? It's a crucial question in a market where retail investor sentiment is so powerful. Looking ahead, Opendoor faces several key challenges and opportunities. On the opportunity side, a sustained drop in interest rates could be a major catalyst, as it would likely reignite the housing market and validate the iBuying model. The company's push toward a more diversified, capital-light platform is a sound long-term strategy that, if successful, could make the company more resilient and profitable in all market conditions. This pivot is the true long-term thesis for the stock. If Opendoor can transition from a pure iBuyer to a comprehensive real estate platform, that offers services like mortgages, insurance, and agent services, it could create a durable, high-margin business. This is the ultimate hope for investors who are looking beyond the daily stock swings. On the risk side, a continued high-interest rate environment would put immense pressure on the company. The company's guidance for a weak Q3 revenue and a return to losses is a clear warning sign. Additionally, while the company's adjusted EBITDA turned positive, the net loss remains substantial. The path to sustained profitability is a long one, and the current stock price seems to be discounting this real.